Hello, hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 6th of March, 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday, because yesterday we do have a slew of key events to highlight, spanning from the US, China, and as well as Europe, and how does it impact the broad-based cross asset classes first. So let's start from US over here. So you know that US yesterday around this timing, the same timing around 10 a.m. Singapore time to 11 a.m. Singapore time, Trump actually do a joint address to the US government, is the Congress, including the Senate and as well as the House. So what he did mention over here is that he's very eminent regarding about the ongoing trade tariffs plan towards America major trading partners, not only inclusive of China, but inclusive of Mexico, Canada, and potentially next one up could be the European Union. So what he mentioned over here is that, let me highlight my screen so that you guys could see that Trump says that is a little disturbance from the tariffs is okay, right? That means what he mentioned over here is that he totally ignore the negative impact of trade tariffs having have on the real economy initially, as well as the stock market. So we know that the US stock market has been in the doldrums since the start of this year. And if you also look at this 3 months rolling performance of the major US stock indices, at the bottom is the US stock indices, the major one, the Russell 2000, the US Wall Street 30, the Nasdaq 100, and the SPX. The one that is flying up high is the Hong Kong 33, represent the Hang Seng Index, and the German 30. So I explained to you why the German 30 we got to be on our radar right now, because of a change in fiscal policy implementation out from Germany. Later I'll share with you guys over here. It's not more pertaining to the ECB right now, but it's taken over by the current ongoing incoming new government of Germany that potentially may kickstart a very significant expansionary fiscal stimulus, all right, all also related to the action of the current US government right now. So I'll touch more about that, but for sure Trump doesn't seems to be concerned about the current US stock market underperformance against the rest of the world. All right, so you could look at it, the US market has been underperforming since the start of this year, and if I stretch it slightly from a medium-term perspective, a 3-month rolling performance as of now we are speaking, very clearly the markets, the US benchmark stock indices also start to show a persistent trend of underperformance against the Hang Seng and against the German DAX. All right, so but what's interesting over here is that we know that on a very short-term intraday basis, Trump's like to massage the market, that's showing that he is in force, and very clearly this happens take shape again. All right, so during the middle part of yesterday US session, Trump said that he actually consider to delay Canada and Mexico tariffs, not all of them, but only on a specific product, automobile, for 1 month. All right, that means he has given a grace period for automobiles products only coming in from Canada and Mexico. So that actually causes a rebound, a steep rebound in the markets. All right, so those who are trading intraday, we're going to be very mindful of this kind of very sudden erratic trade tariff policy announcement that could actually create a very wild swing on the intraday basis, especially on the US stock market, which has taken shape yesterday. So I could see over here is that the SPX 500 managed to did a V-shaped intraday rebound because of this sudden news out from Trump, stating that he may introduce or enact a 1-month grace period only for automobile products coming in from Mexico and Canada. All right, over here, let me share. All right, over here, delay by 1 month. Okay, not the entire basket of goods. It's only one particular product called automobiles. And market view this as positive. Why? Because since he's able to delay 1 month, why not he's able to delay for more than 1 month, and it may cover a wider spectrum of goods as well. But nevertheless, this can change as well suddenly. If suddenly Trump say that he doesn't feel that Canada and Mexico is to adhere to his request, he may just start to slap in more tariff measures on these two trading partners of the US. So things are very, very fluid. So we got to be very mindful if we are looking at an intraday trading setup perspective. I mean, in terms of risk management, we got to take into very, very important, we call it a tool in structuring such volatile uh, environment. All right, so same for the Nasdaq 100 as well. There was a sharp V-shaped recovery, and the Dow Jones as well. All right, so what I could see is that across the board, we see a series of green in the major US stock indices, up by 1.12% on the SPX, the Nasdaq 100 up by 1.36%, the Dow Jones Industrial Average up by 1.14%, and the Russell 2000 up by 1.1%. All right, but overall, underneath, the fundamentals are not that rosy to actually support this continuation of this V-shaped rally may translate into a continuation of an impulsive up move to scale fresh all-time high. The fundamentals are not there supporting. Why do I say that? If you were to look into yesterday's latest economic data release, all right, let me expand my screen. Let me start with the ADP number. Okay, so you know that the ADP employment change is like a tier 2 job data for the US, or we can look at something like a prelude to tomorrow NFP data. So NFP data is compiled by the government's statistical board. ADP is also employment data in the US, but it's compiled by the private sector, which is ADP. Or ADP is the firm of the private sector. So the ADP employment change, right? The data came in worse than expected. So market is expecting 140K jobs added, but came in 77K. Okay, indicating that is not so rosy employment market in the US as compiled by ADP, the private sector. And if you look at the ISM services, yeah, ISM services, I do mention that there are various sub-components that we need to take note of. Yes, the headline services PMI continue to show expansionary, we call it environment for the services sector or the services industries in the US, because it stayed above 50 at 53.5, also above 52.8 that was printed in the previous month of January, and also came in above expectation of 52.6. But however, the cost of business, or the cost of doing business in the services industry in the US, that means we talk about the input cost of this services industry business in the US, continues to rise. If you look at the services prices over here, all right, so the services prices, consider this as a cost of business or input cost of business for the services industry in the US, rose to 62.6, above 60.4, and also above expectation of 60. All right, so if you look at the trend of the services prices over here, that means we talk about input costs of this services business, or businesses within the services industry or the services sector in the US. All right, so the cost of doing business in the services industry actually rose to all right, going to go up. So you look at the 10-year trend, very clearly it starts to shape a U-turn since the low of June 2023 at 54.4 and March 2023 at 53.4. So this is something like a double bottom formation over here. All right, so that is also a concern to the real economy. That means, i.e., labor market is not so rosy by that ADP number that I flashed you all that came in below expectation. Input cost of doing businesses in the services sector or industry in the US also starts to rise. So there's also a risk of what I call stagflation. That means slow down in growth, but increase in cost pressure or inflationary pressure that, that could be passed down to end user. And that also starts to see among Wall Street. So Wall Street actually over here right now has starts to looking for the risk of recession risk in the US. All right, so by looking at their individual model from various Wall Street bank like JP Morgan, Goldman Sachs, so they managed to compile saying that recession risks are growing based on a couple of instruments that are looking at 5-year treasury, base metal, then especially the Russell 2000, which is a very close proxy to the US economy, the S&P 500, the high yield credit yield spread, and the high yield credit spread yield spread as well. So yield spread between the US treasury and the corporate bond spread. So there's a big risk that growing recession risk, or it could translate worse come towards stagflationary risk. So that could potentially put a cap on earnings growth in the US stock market. So that's why we explained to you, number one, now why the US market is underperforming because of this underlying Trump trade tariffs policy causing a rather lackluster fundamental that is playing out in the US economy. So that's why, based on this, whatever rally that we see yesterday may not be extensive enough to translate to fresh all-time high on the US stock market at this moment in time. All right, so it's more like a corrective rebound. We're in a very messy intraday trend scenario. Okay, later I'll touch on more about the intraday technical outlook on the major US stock indices. Now, onward next will be the FX market. So FX market over here, we start to see a very strong dollar. Okay, so yesterday we were unsure about the technical configuration on the sterling and the euro, so we flipped to a neutrality stance. So very clearly, the euro dollar and the sterling dollar broke above the upper limit, that means showing very strong euro strength, translate into a very strong sterling strength as well against the dollar. So this is a 5-day rolling performance of the US dollar against all the major currency. That means the dollar is a base currency. $1 equals to how many euro? So the dollar is the weakest against the euro yesterday, as it's also trade below the dollar index performance. Okay, so right now the 5-day rolling performance of the dollar against the euro is at negative 3.7%, faring much more worse against the dollar index, which is down by negative 2.75%. And why this strong euro dollar performance, or a very significant weak dollar performance against the euro, is because of the change of policy stance in the anchor Germany economy of Eurozone. So what do I mean by this? So if you look at it over here, where is the data I want to share with you guys? Okay, this is the data. Okay, so right now the German government take a lead from the previous ECB, whenever it takes moments to actually boost the what I call Germany or the Eurozone economy. So what I could do over here is that uh, pardon me, there's a bad cough. Okay, Germany historical plan to ramp up spending shook sort with on Wednesday. All right, so the result over here is that the next prime minister or chancellor in waiting, Frederick Merz, declared that Germany will do whatever it takes to defend itself and pledge to ease constraint on government spending. That means previously Germany tends to be much more conservative in government spending, and right now he wants to remove the cap and increase government spending in Germany on infrastructure and as well as defense over here. Because if you look at, okay, there is a, okay, let me share with you what is this defense spend. Okay, yeah, this is the one. Okay, over here. Yes, yeah. The German proposed, which must be still secured by the backing of 2/3 of the majority in the German parliament, will set up a 500 billion euro infrastructure fund, exempt defense spending over 1% of GDP from the debt brake. All right, and allow German regional states to run a small deficit. All right, so what you got to do over here is that German now try to actually go away from its traditional roots by having what I call physical spending discipline. But right now he wants to actually, German want to spend more. So that actually also created a push up in German 10-year German bond yield, much more against than the US, and that also causes the 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 euro dollar to actually increase as well. Later I'll touch on more on the the intermarket dynamics. So in the very, very short term, we start to see very positive feedback loop into the euro dollar. That means, i.e., causing this dollar weakness starts to spread across the board. And even previously, the dollar was strong against the Aussie, the Kiwi, and as well as the CAD due to the trade tariffs that Trump wants to impose on Canada. That also got eradicated yesterday as well. The dollar strength got eradicated against the sterling, no, against the Aussie, against the Kiwi, and against the CAD because of that very strong positive feedback loop from the euro dollar. It has a spillover impact to the rest of the FX market. That means we talk about dollar weakness. And what I could see over here is that dollar as a whole also stage a breakdown below the key 200-day moving average as well. Okay, yesterday, right, it has a hourly daily close below the key medium-term pivotal support level at 105.50, and also a daily close below the 200-day moving average. So now it's at risk of trading within a very choppy formation. That means back into where it was again before the sharp rally that took place ex post US presidential election outcome. That means whatever Trump's advocate of Trump's potential what I call America First policy that initially should boost the dollar strength, that has been reduced at this juncture. That means going forward from a multi-week to multi-month perspective, the dollar may start to trade in a very choppy range configuration as it's reintegrate back into this former triangle-like range configuration that has taken shape since 13th of July 2023. That means going forward, it may be just another round of very messy trend movement in general for the dollar index, if we just stretch it from a longer term perspective. All right, from here. Okay, so that is the price action that I want to share with you all yesterday. And also because of this stagflationary risk fear that's taken shape, gold price continues to remain firm above the 20-day moving average. And because of this slowdown in this potential US recessionary scenario over here, which is the Wall Street Wall Street banks has starts to warn out these recession worries, that causes the West Texas crude oil to plunge by 2%, WTI crude. So, but however, WTI crude plunged right exactly at our key medium-term pivotal support level at 67.50. So later I'll share with you there could be a chance of a tactical rebound taking shape on the intraday basis when I cover the intraday technical segment outlook on West Texas crude oil. And also one thing I'll share with you all is a change in China policy going forward. All right, so China policy right now, you know that yesterday I did mention, right, Premier Li actually released their 2025 goal plan for Chinese economic growth. So I cover that potentially there could be much more forceful fiscal stimulus coming to play because China introduced a higher budget deficit of 4% of GDP this year while still maintaining 5% GDP growth, despite the fact that the external environment will be less rosy to China because of Trump incoming trade tariffs, and it could be more going forward this year. And during the work report, Premier Li did mention about consumption to boost consumption. You could see over here. So boosting consumption in yesterday's work report that was being announced in the 2 session was increased to 27 times. All right. Last year was 19, increased to 27 times. So by mentioning about this word consumption or boosting consumption in the work report, highlight that the Chinese top policymaker now is pretty much concerned about that deflationary risk spiral in China, and in order to eradicate that or negate that, consumption spending got to go up. And how do you increase consumption spending is through consumer confidence and by boosting employment among the Chinese people, and also asking or what you call it, asking leadership from the private sector that is targeting consumer sentiment to actually take a lead to actually boost this particular sector of the economy. And that also explains the reason why China big tech bosses last week was actually granted an audience to presidency China presidency, President Xi Jinping before the start of the 2 session this week. All right, so Jack Ma was also in the picture as well because all these China big tech stocks heavily concentrated to target the consumers or the services sector of the economy, which also indicating a boost of consumer sentiment. So that was this report yesterday. It linked up to this priority in boosting consumption in the work report. And previously, President see a pet what we call high quality manufacturing development. This particular phase has been dropped yesterday. So yesterday, it was only mentioned 7 times in the work report from a high of 25 that was seen on 2024 last year report. So we start to see a change in tonality or strategy, economic strategy planning among the top China policy makers, switching gear from emphasizing high quality manufacturing development in the US, right now targeting the internal domestic economy of the Chinese economy, pardon me. So switch from high quality development manufacturing. Previously, that was a cornerstone of China policy or economic policy in 2024. Right now, the cornerstone of China top policy in 2025 is to boost consumption in the internal domestic economy of China. So that also explained to us the positive feedback loop that is being seen on the Hang Seng stock index yesterday, and as well, most importantly, the China big tech stocks, which is on the Hang Seng Tech, has outperformed yesterday as well. All right, later I'll touch on more of that on the Hong Kong 33 benchmark representing the Hang Seng Index in my short-term technical outlook. All right, so that covers the intraday, no, that covers the daily dose first segment where I highlight what happened yesterday, news flow, important events, and how does it translate to the market price action movement. All right, so now let me share with you one intermarket dynamics that is most pertaining to the strong push up on the euro dollar yesterday over here. Right. Okay, so hopefully you can see my screen on the chart. Okay, give me 1 second. Yes, this is the chart over here. All right, so at the top of this chart here is the 10-year German bond yield. All right, so the 10-year German bond yield yesterday staged a very strong bullish breakout over here, breaking out from a bullish flag formation, or we'll call it a bullish pennant formation. Okay, let's put it in green. Okay. Okay, so we cannot to examine FX market, we cannot take things in absolute perspective. So I need to know how strong this 10-year German bond yield. Okay, German bonds, they call it sovereign bond in German, they call it bund, B-U-N-D. So I just use the term as German bond yield. You don't like bund, you can just look at German sovereign bond yield. All right, so it's a government bond yield. So it push up because of that increase in fiscal spending, and the amount is going to be very tremendous based on the latest plan by the new leadership in German political era politics. All right, so this push up in the 10-year German yield was very fast and furious because it's a weekly chart, and you put it into relative perspective, is the yield spread between the 10-year German bond minus the US 10-year Treasury note yield. So this is a yield spread between the 10-year yield and the 10-year US Treasury note yield. It's still trading in a major downtrend phase or a long-term circular downtrend phase since 15 December 2008, right? This strong push up in the German yield managed to actually reduce the gap, all right? Reduce the gap. It's still negative. That means the 10-year German yield is lesser compared to the US 10-year Treasury note yield because it's still trading at a negative 1.52%. But what you could see is there's a key resistance level at negative 1.35% over here. All right. So if we start to see a weekly close above this level, really close above this, because it's a weekly chart, a weekly push up above 1.35, that means i.e. if price action starts to go something like this, and push up a weekly close above it, that will mean that the 10-year yield spread between the German bond and the US Treasury note has staged a bullish breakout as well. And when that's happened, potentially we will start to see the euro dollar also breaking out of a key long-term resistance at 1.1040. Okay, so you realize that the euro dollar is been trading a very strong direct correlation with the yield spread of the 10-year German bond versus the 10-year Treasury note. All right, that means i.e. German sovereign bond yield yields a better attractive return comparatively to the US Treasury note. All right, so the clarity is in parallel, the negative 1.35% is a key resistance on the euro dollar at 1.1040 over here. So this is the euro dollar is still trading within a long-term circular downtrend, right, against the USD. That means the euro is still in a circular downtrend against the USD. But unless we start to see a hourly close and a breakout above 110.40. Okay, so this 110.40 potentially could be triggered by a breakout of that yield spread between the 10-year German bond and the 10-year Treasury note yield at negative 1.35% over here. All right, so something to take note of. So in the very short term, if you realize that there's still a bit of room to push to the negative 1.35%. So in the shorter term, the euro dollar may also shape a push to test that 110.40 level, key long-term resistance, pivotal resistance level. So in a very short-term intraday basis, there could be still some more meat of having a bullish bias on the euro dollar. Right, and eventually it could spill over to the sterling dollar as well. All right, so this is the intermarket dynamics on share real that is very important, that is taking shape in the FX market right now due to the interplay of policy between US top policymaker and Germany incoming new political leadership, right, that's taking shape right now. Right, so this is the intermarket dynamics on share real, more pertaining to the FX market. All right, so with that, let us now jump straight into the intraday technical outlook on the broad-based cross asset classes. Okay, I will stress intraday, that means it's only potentially good for today. All right, so now with that, let me expand my screen so that you guys could have a better view of the charts. All right, good. So let's start with the euro dollar. So still recall the euro dollar, we were neutral yesterday. So yesterday it broke above the neutrality limit, which is the 200-day moving upper neutrality limit, which is the 200-day moving average at the 107.30. So right now we will flip to a intraday bullish bias over here. Yes, the RSI here is at the overbought region, but there's no clear signs of a bearish divergence. So potentially there could be some signs of a pullback taking shape in today's intraday session when the European session opens thereafter. So potential pullback, as long as the pullback didn't surpass below 1.0730, which is the 200-day moving average as well. So using 1.0730 as my short-term pivotal resistance, pivotal support level. Okay, I repeat again, about tongue twisting. So using 1.0730 as my short-term pivotal support level, we'll flip to a intraday bullish bias on the euro dollar, considering there could be a chance of a minor potential pullback or dip during the European session because of the grossly overbought level of reading or condition that's being seen on the hourly RSI right now. Next near-term resistance level to watch in today's bullish biasness will be at 1.0880, followed by 1.0940/1.0970. So 1.0880 is rather key as well, because if we go to the daily time frame chart over here, 1.0880 confluence with the former pullback major trend line support from the low of 3rd of October 2023 now turns into a pullback resistance, all right, graphically at 1.0880. Right, so that's for the euro dollar. Only a hourly close and a breakdown below 1.0730 will invalidate today's intraday bearish bias and consider yesterday bullish breakout above the 200-day moving average as a failure bullish breakout, and where price action could start to shape another choppy movement towards the downside. In first step, exposing the next near-term support level at 1.0630. Below it sees 1.0530 next. All right, so that's for the euro dollar. Onward next will be the sterling dollar. So the sterling dollar also broke out above the 200-day moving average, which is also our upper limit of our neutrality zone yesterday. So the sterling dollar has now just exited from the overbought level as shown on the hourly RSI over here. So but there's no clear signs of a bearish divergence on the sterling dollar. So potentially there could be a minor pullback taking shape as we head into the European session thereafter. So using a 1.2810 as my short-term pivotal support level, which is yesterday's US session, start of US session low as well, 1.2810, and so very close to the 200-day moving average. So as long as this potential minor pullback that could take shape during the start of the European session didn't surpass below 1.2810, we will flip to a intraday bullish bias for the sterling dollar. Next resistance level to watch 1.2965, followed by 1.3025/13040 one-time Fibo extension taken from the low of 3rd of February and graphically the minor swing high area of 30th of October last year and 6th of November last year. Only an hourly close and a breakdown below 1.2810 will invalidate today's bullish bias on the sterling dollar to kickstart a choppy corrective decline sequence in first step. Revisiting 1.2685, a breakdown below it may expose the next near-term support at 1.2640/1.2610. We also confluence with the rising 20-day moving average as well. So i.e. in a nutshell, potentially there could be some form of a minor pullback taking shape during the start of the European session because of the hourly RSI just exited from the overbought level, using 1.2810 as my short-term pivotal support level to potentially see whether the pullback is able to hold at this 1.2810, and we will flip to a intraday bullish bias for today on the sterling dollar. Right, so next up will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar also got shaped a push up as well because of the bullishness that's being seen in the euro dollar, spreading that feedback loop of negative US dollar strength throughout the FX market. So the Aussie dollar also got squeezed up as well above our short-term pivotal resistance, which is at the 20-day moving average. So with that, we will turn neutral for today, neutral between 63.60 and 63 figure. Only a breakout above 63.60 potentially see a retest at 64 figure, which is our medium-term pivotal resistance that we have on the Aussie dollar. So a quick recap on the daily chart. So 64 figure is very important. It got rejected recently on the 21st of February, and why it rejected? Because it was the previously major ascending trendline support now turns into a pullback resistance that was previously in place since 13th October 2023 low. All right, so that's for the Aussie dollar, having a switching to a neutrality stance for today between 63.60 and 63 figure level. All right, lastly will be the dollar yen. So the dollar yen yesterday continues to remain trapped in the sideways range between our first support and first resistance. All right, first resistance at 49.95, tested during the start of the Asia session yesterday before it sold off, all right, throughout the entire European session and US session, and now it's attempting to stage another bounce off it again. All right, so with that, still no change. It's still trapped within this sideways, this region over here. So we will still maintain any bearish bias as it goes up towards 149.95, but I do not put it as my short-term pivotal resistance. Short-term pivotal resistance still remains at 150.95. We also confluence with the downward sloping 20-day moving average. Still maintain that intraday bearish bias. A breakdown below 147.95, then potentially I could tighten the short-term pivotal resistance to 149.95 next. All right, exposes the next near-term support level at 14710/14690, which is a Fibo extension cluster level, and the minor swing low area or the minor congestion area of 3rd of September and 3rd of October last year. All right, only an hourly close and a push up above 150.95 will invalidate today's intraday bearish bias to see a squeeze up to revisit the upper limit of this medium-term descending channel that is still in place since the high of 11th of Jan this year. All right, to have a mean reversion rebound scenario unfolding 15165, 15220, which is the 200-day moving average and the upper limit of that medium-term descending channel that I flashed out you guys a while ago. So i.e. in a nutshell, still using 150.95 as my short-term pivotal resistance to maintain the intraday bearish bias. Unless we have an hourly close below 147.95, then I could tighten the medium-term pivotal resistance to 149.95 next. Right, so that's for the dollar yen. All right, so that's also sum up the intraday technical outlook on the FX market. So moving on, next will be the intraday technical outlook on the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continuing to march upwards with our expectation, now hitting the lower limit of our first resistance zone that we highlighted earlier, 24,195/24,510. So with that over here is that I will tighten the key short-term pivotal support level for today using this former minor swing high of 3rd of March and 5th of March got rejected before staging that bullish breakout, all right, yesterday. So as long as any minor pullback didn't surpass below 23,290, first support level to watch will be at 23,830, the former minor range top of 26th of February and 27th of February now turns into a pullback support level. I'll not put it so tight over here just in case of any whipsaw. So using 23,290 in any case of any pullback, because the hourly RSI is really in the overbought level, grossly overbought right now. So there's a risk of a minor pullback taking shape, all right, at any juncture. So potentially, if there's the minor pullback then surpass below 23,290 short-term pivotal support level, we will still maintain the intraday bullish bias for today on the Hong Kong 33, representing the Hang Seng Index. Next resistance level to watch after 24,510 will be 25,080. All right. However, if a price action starts to break down below 23,290, today's intraday bullish bias will give way to a much more deeper minor corrective pullback to revisit the 20-day moving average in first step. 22,970 in first step, a breakdown below it sees 22,470, which is the confluence, the rising 20-day moving average, the minor swing low area of 20th of February, and as well as the lower limit of this ongoing medium-term ascending channel from the low of 10th of January, which I drew over here in light turquoise green. All right, so net in a nutshell, using a Titan key short-term pivotal support for today, 23,290 in any potential pullback, and remain a bullish bias on the Hong Kong 33. All right, next up will be the Japan 225. So the Japan 225 managed to stage a bounce, but this bounce also seems to be being kept right now at this minor descending trend line that I drew from the high of 18th of February, and which is also right below our short-term pivotal resistance that we highlighted yesterday as well at 37,930. So still no change. We will maintain the intraday bearish bias below 37,930 short-term pivotal resistance level. First support level to watch over here will be the minor swing low of yesterday's start of the US session low at 37,130. Only a breakdown below 37,130 may risk a further slide to revisit last Tuesday, 4th of March minor swing low area at 36,450/36,220. Only an hourly close and a breakout above 37,930 will invalidate today's intraday bearish bias to see a rebound to retest the 20-day moving average at 38,325/38,490 next. Above it sees 38,835 next, which confluence with the very closely to the downward sloping 50-day moving average as well. All right, so in a nutshell, still maintaining that intraday bearish bias on the Japan 225 using 37,930 as my short-term pivotal resistance level. All right, so next up will be the German 30 or the German DAX. So yesterday we were neutral. So the German DAX managed to actually surpass the upper limit of the neutrality zone at 22,950 level. All right, so now potentially revisiting the current all-time high area at 23,300. Right, 23,300. So what I could see over here is that we will still maintain, we will flip to an intraday bullish bias because so far the RSI still maintained rather healthy over here. Haven't hit the overbought level yet. All right, at this point in time. So potentially there could be a bit of minor pullback. First support level 22,950. As long as they push down below 22,800 level, which is the very clear congestion area here. All right, the former minor swing high of 5th of March over here. As long as it didn't surpass below 22,800, we'll flip to a intraday bullish bias on the German 30 above 23,300. Sees the next resistance coming in at 23,000. Above 23,300 sees the next resistance coming in at 23,600, followed by 23,820, okay, which is a Fibo extension cluster level, and also close to the upper limit of this ongoing medium-term ascending channel that I drew from the low of 13th of January. Only a breakdown and an hourly close below 22,800 will invalidate today's intraday bullish bias to see another round of choppy corrective decline, exposing in first step the 20-day moving average at 22,440, 22,440. Only a breakdown below 22,440 may see a steeper corrective pullback, exposing the next near-term support level at 22,120 next, which is the minor swing low area of 21st of February. All right, so that's for the German 30. Flipping to an intraday bullish bias is in any potential minor pullback above 22,800 short-term pivotal support level. Okay, onward next will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average, I mentioned, did a nasty whipsaw, initially sold off, then it pushed up because of that latest trade tariffs news flow where Trump announced that he will actually extend a one month grace period on Canada and Mexico automobiles only heading into US, but still no change. My price action got rejected. A pause. The rebound managed to pause at our short-term pivotal resistance zone yesterday. So still using that 43,120 slash 42,980 short-term pivotal resistance zone to maintain the intraday bearish bias on the US Wall Street 30. First near-term support level to watch will be at 42,210 next. All right, only an hourly close above 43,120 will invalidate today's intraday bearish bias to see a squeeze up on the US Wall Street 30 towards 43,530. Above it sees the 20-day moving average coming close to this graphical minor swing high area of 27th of February and 3rd of March, pardon me, at 43,885. All right, so in a nutshell, still using 42,980 slash 43,120 as my short-term pivotal resistance level and maintaining that intraday bearish bias on the US Wall Street 30. All right, next up will be the Nasdaq 100. So Nasdaq 100 continues to also play around the 200-day moving average over here. Managed to get rejected at our pause. The rebound managed to stall at the first resistance yesterday at 20,720. So still no change using the 21,030 as my short-term pivotal resistance level, maintaining that intraday bearish bias. First support level to watch will be 20,140 slash 20,070. Only an hourly close above 21,030 will see a squeeze up to revisit 21,330 and potentially even 21,560, which confluence closely with the 50-day and the 20-day moving average as well. Okay, these two resistance zones over here. So that's for the Nasdaq 100 using 21,030 as my short-term pivotal resistance level to maintain that intraday bearish bias. All right, so next will be the commodities market over here. So over the commodities market, let us start with gold XAU slash USD first. So for gold XAU slash USD continues to actually trade above our first support level and above the 20-day moving average, so at 2,900, 2,890. So since it can't have a clear break above 2,920, I don't want to tighten my short-term pivotal support level to be so tight at 2,900 level. So I will still maintain 2,877 as my short-term pivotal support level, maintain that intraday bullish bias above 2,923, potentially revisit the current all-time high area at 2,954. Only a breakdown below 2,877 will jeopardize the bullish tone for today to kickstart another round of minor corrective pullback to revisit the swing low area of last Friday at 28,045, 2845, 2834. All right. Only a breakdown below it sees a deeper slide towards 2810. All right, which is the minor swing low of 4th of February. All right, so that's for the gold XAU slash USD. Still maintain the intraday bullish bias using 2877 as my short-term pivotal support level. Right, so lastly now will be on the West Texas crude oil. So like I did mention yesterday, West Texas crude oil plummeted as expected and hit the lower limit of that pivotal support zone, which is the range resistance at 65.70. So this range resistance has been in place since the low of 20th of March 2023. Over here it hit all right, so right now if you look at the current situation over here, the hourly RSI also start to exit from the oversold region, and where it hit, you also hit the lower limit of this medium term descending channel that I drew from the high of 16th of January this year. All right, so there could be some sign of a short-term minor mean reversion rebound taking shape. So using the medium-term pivotal support level of 67.70 slash 67.40 yesterday intraday low, we will flip to a intraday bullish bias for this potential minor mean reversion rebound sequence to play out. First resistance level to watch will be 67.70 followed by 68.80. Only a breakout above 68.80 potentially see a steeper minor mean reversion rebound scenario unfolding, revisiting 70.80, which is so the downward sloping 20-day moving average acting as a resistance, the upper boundary of this ongoing medium-term descending channel, and the minor swing high area of 28th of February and 3rd of March. However, if price action plummet below 67.40, then the impulsive down move may continue, exposing the next near-term support level in first step at 64.80, followed by 64.20/10, which is a Fibo extension cluster level as well. Fibo extension level of 1.382. All right, so that's for the Wall Street. That's for the West Texas crude oil. Pardon me, using 67.70/67.40 pivotal support level for today. Looking for a potential minor mean reversion rebound scenario that may play out. All right, so that also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar for today, which is Thursday. What are the key data to look out for in terms of the economic calendar? So we know that today will be Thursday, and there's this ongoing China People's Political Consultative Conference. So it's today as a two session. So today and the MPC, all right. These are the two. That's why two session. So in today two session, right, very important. Like, there's this MPC Observer website. There's a key press conference by PBOC, which is the China Central Bank governor. All right. So today will be 6th of March. So at 3 p.m. there will be a press. This is very important. A press conference on the economy, and Mr. Pang, the governor of PBOC, China Central Bank, will be speaking. All right. So market will be paying very close attention after yesterday's Premier Lee work report, advocating indirectly much more potential stimulus measure to boost consumer spending. Markets now want to hear from the central government itself. Will there be further relaxation of monetary policy, and how will the PBOC engage or ignite this potential loosening of further monetary policy in line with the work report that was announced yesterday by Premier Lee? So that is 3 p.m. Singapore time. All right, today. Something to take note of. Over here, press conference on the economy. Okay, 3 p.m. today, Singapore time. All right, of this China 2 session today. So now back to the economic calendar over here. So other than 3 p.m. During the European session, there is also another key data to take note of will be retail sales in Eurozone retail sales out at 6 p.m. Singapore time, and the very all important ECB interest rate decision. So market is really expecting a 25 basis point cut to the ECB rate, the depo rate over here, to bring it down to 2.5%. All right, and market will now want to hear the press conference of ECB President Lagarde out at 9:45 p.m. Singapore time, and also they will release a new macroeconomic projection. So market wants to hear in line with the latest, we call it expansionary fiscal policy announced by the new leadership of Germany. How does it impact ECB interest rate decision? So should ECB be less dovish right now? That means, i.e., they need not necessarily take out the additional slack, because if they continues to be much more aggressive in their interest rate cut cycle, they may ignite inflationary pressure in the Eurozone, given the fact that Germany now has started to turn more hawkish, not turn more into a much more expansionary fiscal policy away from their traditional fiscal spending discipline. All right, so something to take note of during ECB President Lagarde press conference, and how does the latest spending plan, aggressive fiscal spending plan up from Germany new leadership impact the monetary policy decision or guidance going forward for ECB, right? So that will offer some clue at 9:45 p.m. Singapore time, and also they also released the macroeconomic projection as well at 10:45 p.m. Singapore time. All right. Okay, so thereafter there will be another speech by President Lagarde at 11:15 p.m. I think that shouldn't have much impact, because whatever she wants to convey may already convey during the press conference earlier on at 9:45 p.m. All right, so that's yep, that should be it over here. So that should sums up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.